Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for June 5th, 2022. Hope you guys and gals are having a great weekend. Happy summer to some of you. Happy end of spring, early summer to the rest of you, depending on where you're at. Anyway, I hope you guys and gals are having a great weekend. All right, before I get started, I wanted to mention we have a new website for the F.A.C.E show. Now, it's F.A.C.E-experience. We have interviewed, now check this out, check out these stats. This is pretty cool. You know, we've been going for about 6 years for this particular show. We've had over 1,100 shows, 700 interviews of some of the, top industry experts, whether they're fund managers, they're analysts, they're traders, they're economists, and we've had over 400 guest speakers. And you can see some of the content and some of the people that have come in and their positive comments regarding Dale, our host on the F.A.C.E show. So check it out. And if you guys and gals you have a company that's in the financial industry and you want to be a sponsor of our free F.A.C.E show, we're open to it. So make sure you reach out to us. I also need to mention, if you haven't tried out Forex Analytics, you might as well do so. It's only $1 for 10 days. We actually updated the mobile app. So the mobile app has all these new features, and we've upgraded. It's the first time we've upgraded it in like 3 years, maybe 3 or 4 years. Anyway, we've added a lot of great features. You can see like our private news flow there, live squawk. You have risk management calculators. The patterns in play. You have all the analysis. The charts that are incorporated into the app. Really cool stuff. So check it out. You can have all this on your phone or your mobile device. It's only $1 for 10 days. Try it out. And then after that, it is priced at $120 a month or $119 a month for the premium service. But even if you want to stick with the light version, which is only $20 or $19 a month, you still get to get all the private shows that we do for just the Forex Analytics community, and you get the mobile app. So great stuff. Make sure you check it out. Hope to see you there inside of our community. We have probably one of the most robust trading communities around. Literally so many people talking around the clock. It's awesome. And there's so many trade ideas, different rooms to be in. All right, so let's talk about this next week. And why is this next week going to be important? Well, it's going to be important for a few different reasons. We have the European Central Bank. We have the RBA that's meeting. We have Canadian unemployment. And here in the U.S., we have the most important data that's coming out at the end of this week. We have CPI data. So it's going to be a very, very busy week in the markets. So let's start off talking about the euro dollar and why it's so important. Because last week, if you go back to last week, you will realize that we talked about the euro and about the resistance at the 108 level and how important it would be. Now, I'm going to reiterate how important it's going to be, because if you go over to the weekly chart and you look at, when the euro was created right around 2000, okay, when the euro, that's basically when we put in a low. If you take that trend line, you go all the way to present day, it comes in just above 108, maybe around 108.50, 109. Now, if you take the last few years since 2000, I almost said 117, 2017 lows, end of 2016 lows, 2020 lows, and then the previous lows back in March, we basically are back at previous support acting as current resistance, underside of that trend line, and we knew this week that 108 was going to be a big deal. Why did we know it was going to be a big deal? Well, if you actually take the high from this year, so February of 2022 of the euro, I know some of you wish the euro was still up there, but you never know. We might get up there soon. Notice that the 38% retracement has capped the rally. That's another reason why we thought 108 would be big. Go back to last week's week ahead video. You'll see that. So we did stop there. Now, why is this so important? Well, the reason why this is so important is because the 38% retracement will drive either a continuation of the euro lower back to parity, or a reversal, and we could see a reversal of that trend completely. So the 38% retracement usually tells me whether or not we're going to have a continuation or not. Obviously, that's going to lay in the hands of the ECB going into Thursday of this week. Okay, now I want to actually remove that for a second. I'm going to remove that for a second. I'm going to take away this fib level, and I want to talk about how important the current price action of this last week is. Because if you take the rally that we've seen, and I know a lot of you were long the euro dollar with me, sub 104, and wrote it out this week. It was great. I sold the euro earlier this week, took some profits. Now, notice that we stopped at the 38% retracement this week. That comes in just above 106, 106.25. So you guys just understood what I said a moment ago about, the pullback to the 38% retracement could represent a continuation pattern if we break through 108. So another reason why this is so important, let me go delete this really quick. And I want to show you one other thing. Whoops, let's remove that. One other thing here regarding the euro. Let's take this, the highs from 2022. Then we have the April 22 highs. Then we have this last week's high, and then where we are at on Friday. You can see that's a descending trend line. So you can see how important it is if the euro breaks above 108, we are probably going to get a continuation back to the 200-day moving average. Now, I know a lot of you are some euro bears, and you believe that the euro should be seeing parity before it sees 110. Well, the fact of the matter is, if we get above 108, I don't know if you want to be short anymore. For those of you that are shorting the euro, the flip side is, if you're long the euro, if you get back below 106, I don't know if you really want to be on the long side. So the good news is that we have a very, very well-defined breakout point for the euro above 108 or below 106. And I think it's safe to say, from my point of view at this moment in time, based on the information we have in front of us, a move below 106, we're going to be targeting those lows again, or close to those lows, maybe back down towards 104. We get above 108, we're probably going to see 110. So all of that really depends on the ECB. Now, let's talk a little bit about the ECB and why this could possibly happen. Well, everybody knows the path of the Fed moving forward. We're going to raise rates by half a percentage point, 50 basis points, in this meeting and in July, and then quite possibly after that. And, everybody knows that the Fed is pretty hawkish, and that's been baked into the price. Everybody's aware of that. What's not baked in is what's going to happen with the ECB. This week, no one's expecting the ECB to actually raise rates, but they're expected to open the door to possibly raise rates in July and moving forward. Now, a lot of people and a lot of economists, and even economists and analysts that I've met with, have told me in the past they do not expect the ECB ever to raise rates. Obviously, expectations are shifting. What they have room to do is shift even higher. Because if you live in the Eurozone, you live in the UK, you live somewhere in Europe, you know that inflation is an issue. It's not a benign issue is what I was going to say, but it is an issue. And therefore, the ECB may have to choose to tackle inflation over growth, sending the Eurozone in a possible recession if we're not already in one already. But those expectations for higher rates can be ratcheted up. And for the Fed, we already have high expectations. What if growth starts to slow here in the US? What if inflationary pressures start to come down? Can the Fed become less hawkish? When you see the ECB go more hawkish and the Fed go more dovish, that tilts that pressure towards the euro and away from the dollar. That could easily put the euro back up towards the 200-day moving average if we get a shift in those expectations as early as this week. That's why you have to be paying attention to what the ECB is doing. And let me just remind you, if you're not listening to the F.A.C.E webinar every day, it's free. You'll get my updated views. You will get my team's updated views throughout the course of the week. You're only listening to a once a week ahead video right now. But if you want our daily views, come listen to the show. It is free. Plus, we'll be covering the ECB analysis right as it's happening. And then also we're covering CPI live. I mean, Canadian employment this week. So make sure you're there. All right, back to the analysis. So that's how I feel about the euro. Above 106, or excuse me, below 106, above 108. Those are our breakout points, and it's going to be a breakout. It's going to be a breakout. Now, it doesn't have everything to do with the euro. It obviously has, a lot to do with what's happening in the S&P as well. So if you take a look at the S&P, let's not ignore the fact that we are above 4,100. Now, there were and probably still are a lot of S&P bears. They were bearish below 4,000, and they're probably second guessing themselves while we're above 4,100. Why? Because 4,100 or 4060, you can say the neckline to the head and shoulder pattern was right around here. Now, the head and shoulder pattern, in my view, doesn't actually negate until we get, thank you, searching for words, weekend, Saturday morning, me filming, searching for words. It doesn't negate until you get back above the shoulder, the right shoulder. Okay, so we could still work our way up towards the 200-day moving average, move lower, and still have a head and shoulder pattern. All right, but are people that are short or wanting to be short, are they going to stick around if we break higher? Probably not. So the reason why we're going back to that 38% retracement now, the reason why this is so important is if you take this previous support right over here, you take the 38% retracement right here, that comes in at 4,200. My 2 cents is if we break above 4,200, we're probably going to be trading back up towards 4,400. Now, the market is extremely bearish, right? I mean, sentiment is bearish. Everybody's fearful. Everybody's talking about a recession, a depression. There are very few people talking about no recession. People talking about inflation, sticky inflation, stagflation, you name it. You throw everything you have at the market, and guess what? We are back above 4,100. So what is and what would be the pain trade moving forward? We talked about this on Friday with Stelios Kontogulis, and I asked our team, are we going to see 4,300 before, or 4,300 or 3,800 first? Everybody said, well, probably 3,800. But Stelios said the pain trade would be higher, and I agree with that, because everybody is so bearish. Everybody's looking around saying, how can the market rally? Well, guess what? Market's probably going to have a path of least resistance above 4,200 to get back to the 200-day moving average. As much as you all and myself included, we'd be scratching our head going, oh my gosh, I cannot believe we're rallying. That is entirely possible. Now, I don't want to really get bullish until you get above this 38% retracement, but I think there is some upside. Now, I do believe stocks eventually are going to be moving lower, but I actually believe that we could go higher before lower. I also explained this on the trade-off show with Chris Weston and Pepperstone Securities this last week, that I think the market will move higher before lower. Just as I was bullish down here at 38, 3,900 2 weeks ago, I'm still in the camp that I think we could squeeze higher. If that happens, the reason why this is so important, if that happens and the market does squeeze higher before it moves lower, what's probably going to happen is you're going to see the dollar move lower before it moves higher. Now, the dollar, going back to our analysis with the euro, you notice the dollar stopped at the 38% retracement. We have created a false breakout above the highs, above 103. My opinion is the risk is an AB equals CD that takes us back down below 100 before the dollar finds its footing. So if you put 2 and 2 together and you say, well, if the S&P does rally and it continues to rally, the dollar is probably going to sell off as a result, as the dollar is the de facto risk aversion currency. One of the benefits that the dollar has as being the reserve currency is it is the risk aversion tool of choice. When the poop hits the fan and everybody says, oh my gosh, the markets are going to come unglued, sell everything, put me into cash. They're not putting cash into the Argentinian peso necessarily. They're saying, hey, just put me back in dollars for now, right? And I'm using Argentinian peso or any other currency for that matter. But when there's risk on or people need to deploy funds back into the market, they will sell their dollars and put them back into euros, Aussies, stocks, commodities, whatever it is that they're buying. All right. So that's important that we recognize that about the dollar is if the stock market does break above 4,200 on the S&P, the likely unbeneficiary, making up words here, the likely asset class to get hit the hardest would be the dollar in that situation. The flip side is, hey, if stocks revisit the lows and we have the S&P say, you know what, that's not going to happen, Blake. We're going to actually see a reversal lower from 4,200 down towards the 50% retracement at 3,500 in the S&P. If that's to happen, then the likely beneficiary would be the dollar index. But if you look at it from a technical perspective and you just think about this, just look at it. False breakout above the highs, false breakout above the highs of 2020, false breakout above the highs above 2017. And now we are trading below that dotted trend line, which is all of those highs put together. We are trading below that now. It's a lot of false breakouts, right? So if you're long dollars at the moment, you are fighting an uphill battle at the moment, right? Okay, now here's another thing. And this is something that I want to talk about regarding the dollar. Not all dollars are created equal. The dollar yen is not a currency I factor into the dollar index because the yen tends to do its own thing because the yen is it follows yields. It tends to be more of a risk on, risk off currency. And the yen is unloved because the Bank of Japan is going to keep their hands in their pants. They're going to keep their hands. They're not going to do anything. All right. So they're going to just not do anything when the other central banks have to start raising rates because they've already chose that they want to, they're not going to let their currency strengthen, and they're going to deal with their bond markets and their JGB purchases, and they're not going to be dealing with the yen. So they're going to let the yen continue to weaken. Well, as a result, if you have the dollar moving higher against everything else, the yen moving lower against everything else, then you're going to have a dollar yen that is much stronger, which could then, if you look at a bull flag pattern, whether you draw your flag like that or you draw your flag like that, we're heading to 135 or higher based on, these technicals if we break above 130, 135. But it's not just the dollar yen, folks. You look at currencies like the euro yen, it's breaking out. We closed the week in breakout territory. Look at the Canadian yen. We broke out and we closed the week in breakout territory. Now, there is a cross rate effect between what's happening with the yen pairs and the dollar. If you are, short the euro dollar and the euro yen starts to break out, that's not good news because the euro yen is one of the most actively traded currencies in all of the currency market, in the Forex market. So if you have the euro yen breaking out, it's going to feed into other euro pairs like the euro dollar. Same with the Canadian yen. You got the Canadian yen breaking out. I have a hard time shorting Canadian dollars when that's happening. Now, what happens in Canada on Friday if you have a Canadian jobs report that's strong? Well, you might have a Canadian yen that's trading significantly higher. Remember, we closed the week in breakout territory. Then you have other pairs too. You have the Aussie yen that's getting towards the highs. You got the Kiwi yen that's, racing up towards the highs. Even you have the Guppy or the sterling yen that is right now, as we speak, we closed the week at the 618. So if we break above this horizontal resistance right here, even the sterling yen, if the sterling yen's going up when the sterling is getting slapped all over the place, that's something we should be paying attention to. Now, I have to mention this, guys and gals. If you think you are a good trader and you want to try out Forex Analytics, well, visit our sponsor of this show, the Trader Funding Program. You can learn how to access larger amounts of money through an assessment. You get Forex analytics for free because we want to make sure that we want to try to make sure that you succeed. So we'll give you all the tools that we have at our disposal to try to get you to succeed, so you can trade a live trading account, which is a much larger trading account that you might have right now. If you want some more information, there's a 2-minute video right at the very bottom that you can watch. And that's the Trader Funding Program. So check it out, because we have people that are accessing live trading accounts every single week now. So a couple things I want to wrap up with. It is going to be a busy week this next week. CPI, inflation is on everybody's radar this week. Inflation. And I say this week, right now, right? So, make sure you're paying attention to what's happening with the CPI data this week. Be live with us on the F.A.C.E experience and the F.A.C.E show on Friday. So we'll be covering the market live with you, right with you. Okay, so we'll see you there. And I want to say thanks everybody for joining in today. If you like this video and you think it's going to be helpful, give us a thumbs up. My team appreciates it. I appreciate it. Make sure you subscribe to the channel. Thanks for tuning in. You guys and gals have a great remainder of your weekend. I'll catch you on Monday on the F.A.C.E show. Bye-bye. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.